Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for an options expiration review, we have Mark Phillips, CEO of Harbor State Financial. Mark, it's great to see you again. Welcome back to Trade Talks.
You too, Jill. Thanks for having me again.
And this certainly was an interesting cycle, certainly more volatility back into the market. What can you tell us on options expiration Friday?
Yeah, I think, that's one thing that's a bit different here, this May expiration, than what we've seen over the last two cycles. And that's quite a bit more choppiness in the markets. Starting last week, we've started to see quite a bit more movement, both in the broad indices and as well as in some of the individual names. VIX expiration was this Wednesday morning, and we got a print over 25 there. From the last week of March until just this past week, we never saw a reading over 20 in that index. So we're definitely starting to see a lot more activity here. But even compared to those levels, the prior 6 weeks were moving even less than that. So even the realized volatility out there in the market was much lower than the implied levels. I think the average daily moves during the month of April were less than half of what the options were implying. So even though we had that, somewhat lower implied volatility levels, the option or the actual markets were moving quite a bit less. It's been a good time to be a delta neutral or long delta premium seller. But all of a sudden, the average daily moves that we've seen over the last 10 days have been about double what the previous cycles have been. So I think it's actually a great example of one of those curious market options pricing features, where the volatility tends to cluster. And so, we tend to see volatility and market movements tend to come in fits and starts. An implied volatility reading of about 20 right now would imply that the market moves 1.25% a day. Most days it actually moves much less than that. But all of a sudden, when we do start to see those movements, they tend to come together. And statistically speaking, we say that like the distribution of the variance isn't necessarily consistent. So all of a sudden, we're seeing a lot more of that variance, and that certainly makes going into expiration a little bit more choppy than we've seen over the past couple cycles.
And that is the risk that comes with selling premium there, because the vol pops can be a little bit more extreme than on the way down, can't they, Mark? So let's talk about some of the particular features of this current choppiness that you're paying attention to.
Yeah, so I think one of the things that I'm sort of seeing right now in the markets is that there's a lot of this, what I'll call hot money flowing around. And, whether it's coming from stimulus payments or maybe it's the large unrealized gains that people are seeing on a lot of their assets. Over the past year, broad markets are up over 40%. And I think the further out the risk spectrum you go, the bigger those gains have been. So, speaking out the risk spectrum, I think we're starting to see that asset classes are becoming increasingly intertwined, and notably kind of the crypto digital asset markets and the traditional asset classes. And I think we'd be remiss to ignore some of the effects of the major sell-off in the digital asset space and what that effect is having on some of the traditional markets. That hot money crowd is de-risking. And, when you get liquidated on one of these leveraged coin positions, there's a good chance that you'll also be selling off some of the high beta names that might have a similar risk profile. So the speed of that hot money and that active flow between main stocks, main coins, and even options, high vol names, there's a lot of ways to get convexity out there for people, and there's a pretty tight linkage between all of that. And so the speed with which that happens now is far greater, and it only takes a few mouse clicks to move this money around. So I think that velocity is really going to show up in the asset prices themselves ultimately.
Yep, that's a great point that you're making there, Mark. And to wrap up, how would you think about positioning going into a potentially higher vol environment?
Well, as a vol trader, as someone, that thinks about the distribution of vol, like I said, you start to see a little bit of vol and you might expect even more vol. So, one of the ways that I think about tactically positioning here is sort of hedging yourself between potentially the vol coming back down and us settling into what looked like, the last 2 months, or I should say what the last 2 months looked like, but also being prepared for that sort of second leg down. And I think a credit back spread type position is something that we think about here. And so this is the type of position that you probably put on with a ratio where you'd sell, one nearer to the money put, but then get long more of the out of the money puts. So like a 1x2 where you're long too far out of the money puts, short something nearer to the money. Typically, you can put that position on for a little bit of a credit. But if we really do see the markets drop, you have those two options that are further out of the money that'll start to come into play. It's a position you'll want to actively monitor and look for roll opportunities because if this choppiness continues, there are definitely going to be changing opportunities out there. So a lot to pay attention to going forward.
It certainly is, Mark. Thank you so much for the insight as always. And thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.